Right on, Ron Carruthers here. It is Tax Freedom Day in California. If you don't know who I am your main man for everything college, finance, retirement, and tax savings related. So today we're going to take a little break from the college stuff and chat about what Tax Freedom Day actually is, and 3 tips for lowering your taxes in 2019, and 1 thing not to do. So let's get started. First of all, Star's cruising with me today. Can you see Star? She's got her lion cut. Say hi, Star. She gets to go to the office because I'm going to be there late. Hopefully the one client coming in, everybody's phone appointments, hopefully the one person coming in isn't allergic to dogs. Oh well, we'll find out, but there's not that much of her. Anyway, here's the deal with Tax Freedom Day. Tax Freedom Day in California, which actually was 420. Some of you might have been celebrating something else on 420. Plus today's Monday, so it's the first real day back in the workforce. Tax Freedom Day represents the day when you allegedly have done all your work for the government up to that point, and from this point forward, you actually get to keep what you make. So Tax Foundation kind of studies the statistics, and I don't think it's totally accurate. For instance, I believe we are almost up to $2 a gallon in taxes just on a gallon of gas. So gas here in San Diego, over $4 a gallon. We have sales tax. We have every kind of tax you can imagine. State tax, the highest income tax in the country for the state. And then we've got the federal tax. So here's a couple fun facts I thought you'd enjoy before we get to the meat of the conversation. First thing is, when the income tax started 106 years ago in 1913, it was a temporary measure designed to help with some international stuff and with the threat of World War I on the horizon. Of course, it's still, I don't know that it's still temporary, but 106 years later, it's still going strong. The highest marginal rate that we've ever had was during World War II, and it went up to 94 cents of every dollar that you earn would go to the federal government over any income $200,000 or more. Now that's not income inflation adjusted, it's just straight income. But there were people making $200,000 a year. Ronald Reagan, by the way, was one of them. He actually made more than that because he was making around 3 to 4 pictures a year up to that point, paid about $100,000 a picture, and from that point forward, he only made 2 pictures a year. There was no point making anything beyond that. Government would keep everything. Well, I guess he'd get the 6 cents on the dollar, but then the state would take that. So when the New Socialists and the Democrats talk about a 70% tax ratio limit or 90%, just note it's been done before, so it's not totally out of the ordinary. The 80s, when Reagan was president, was the closest thing we ever had to a flat tax. And then here's something very interesting. You should be getting back your 2018 taxes right about now if you haven't done them already. And what you'll likely notice is that you probably, believe it or not, paid less. We're noticing 4 out of 5 of our families paid less. Now, they might not have gotten as big of a refund. In fact, they might have even had to pay some taxes, pay back. But that's because most people we saw got the withholding tables adjusted, so they're getting back more every check. And one of the biggest reasons that some of the higher income families are paying less right now is because there's a sneaky tax kind of put in effect in the 70s called alternative minimum tax. Basically, right about the time that 401ks and IRAs came out, because they're not that old, at the same time, you began to take mortgage deductions. So you could take a deduction for the interest that you paid on your mortgage. Well, one of the things that the government wanted to do was avoid people buying bigger and bigger houses, so they put an alternative minimum tax in there. It's basically a separate calculation to determine if you need to pay more in taxes than you did. And it basically took your mortgage deduction, your state and local tax deduction back, all those sorts of things, recalculated the tax. Here's the problem. They didn't really adjust that for inflation for almost 40 years. So the original intention was to hit anybody in the 70s that was making over $150,000 a year income. The problem is, because it didn't adjust for inflation, it began to affect normal, quote unquote, normal people, not the top 1%, which was kind of the idea at the time. So a lot of my clients, particularly if they gave a lot to charity or lived in a high tax state like California or had a big mortgage, they were getting hit with an alternate tax anyways. So even with some of the state and local tax deductions going away, like here in California, my average client that I saw overall paid less, regardless of whether they got a smaller refund or ended up paying a little bit. Overall, we had one client get a $40,000 pay raise. Went from like 119 to almost 160, and paid the exact same federal tax as he paid the year before without the $40,000 increase. So I don't know that the White House's people are doing a real good job of making sure everybody understands that, but just having looked at a lot of tax returns, which I do for my clients, to make sure they're optimizing their deductions and figuring stuff out so it looks good for college, I just noticed I compare them year over year, and guess what? Most paid less. So anyway, what does that mean for you going forward, and how can you pay even less? I'll give you one final fun fact for the day, which is the Supreme Court ruled years ago. Judge Learned Hand. By the way, check out the ocean today. It's beautiful here. And for those of you who ask, invariably I get questions like, why are you driving in a right-hand car? It's a front-facing camera on my phone. So I have a British car. Shocking that it actually runs. But anyway, this driver's side is on the left side of the car. It's not anything weird like that. Although I am fully proficient, since my daughter lives there, in driving on the left-hand side of the road in a right-hand seat. Got that down. Learned it in Ireland. Didn't even kill anybody to learn it. So the Supreme Court, Judge Learned Hand, wrote the majority opinion that you are not behaving illegally by trying to arrange your affairs to pay the least amount of federal taxes possible. In fact, he went one further and said you're not even being unpatriotic. So, what are your 3 tips? And what's the one thing you shouldn't do? Tip number 1, you definitely want to participate in an HSA. It's a health savings account. If your company offers one, or if you're self-employed and can get one, and that will go through and allow you to pay tax deductible contributions to an account to pay some of your health expenses, and then you can withdraw tax-free. Now, let me tell you the one thing not to do, particularly now. The number one tax tip that the financial analysts and pundits and journalists who don't deal with taxes for a living, don't do financial planning, they're journalists, I always tell you, you gotta max out your 401k, gotta max out your IRAs. No, you don't want to do that. Stop that. Stop that right now. The reason is twofold. Number 1, you are not saving tax. That's the biggest misconception there is. You're not saving any taxes. You are merely postponing paying them. You're not only postponing paying them, you're postponing the calculation of the tax. So guess what? In the 70s, the 1970s, when these plans started, if you turned around and put money aside, the top tax rate then was 70%. Well, if you're withdrawing now at 15 or 22 or 24, you won. But taxes are on sale until 2025 under this new proposal. So you don't want to be deferring, particularly when you have a whole class of young congressmen talking about how they can't wait to raise your taxes sky high. You got Bernie saying it. You got the young Congress people. Once you defer this money and you turn 70 and a half, you have to start withdrawing it, whether you need it or not, because they want their tax on it. So if they turn around and deem that taxes are now 70%, you have to turn around and pay it. No ifs, ands, or buts. So you're putting them in control of your money, not you, and that's not what we want. So, as far as IRAs go, don't do them. Roth IRAs, perfectly acceptable, because you're paying the tax now, getting it over with. You do the rest later. But any sort of regular IRA, set plan, 403b, 401k, above the match, don't do that either. Don't want you doing any of that. That's not you're not saving, you're merely delaying. Oh, and God help you if you die with a 401k or an IRA, because those tax rules are even worse. All right, next thing. So that's the one thing not to do. What should you do instead? We'll chat about that. I'm actually going to put a webinar together. Make sure you know about it, about what the alternatives are instead. What is your second area of tax savings? If you have any capital losses, so if you have stocks that you've been holding for a while that have lost money, you can sell those and write them off up to $3,000 against your current income. Not a huge savings, but here's the thing. The market's at or near all-time highs. So if you have stocks that are still losing, the odds of them ever coming back are not good. So what you probably want to do is go ahead and get rid of those, bank the loss. You can take up to $3,000 of it a year. You're good to go. But the best one I save for last. So here's what that is. Do you know what the number one tax savings vehicle is? Think about it for a second. It's not your house, buying a bigger house. It's not deferring into your 401k. That's not saving you at all. At least on the mortgage interest, you don't have to pay it back. You ready for it? It's a side hustle. You heard that right. Side hustle. That's the word for it. We used to call it having your own business, having a home-based business, having a not home-based business. And it can literally be anything, although it should be something you have a reasonable chance of making money at and something you'll enjoy. But we live in a gig economy where people do all kinds of things for money. And so in addition to their main job, that is, if you set up a side business, you instantly have all the benefits that the largest corporations, the biggest companies in the world actually have. And the reason why they give you those is to incentivize you as a small business to go and create jobs. Most small businesses fail, although we're not encouraging spending lots of money to get this business off the ground. In fact, I'll tell you, the number one place to learn how to set up a side business is Udemy. Udemy.com. Udemy.com is one of the best places. They have everything. You can learn to code in there. You can learn how to do PR. You can learn how to do Google AdWords. You can learn how to make money with YouTube ads. You can learn how to be a consultant for pretty much anything you want. So we recommend, and at least several times a year, their classes go on sale. And I got so busy doing this video, I just drove right past my office. I'm going to turn around now. Their videos go on sale, so generally their courses might be $100 to $200, and at least once a year they all go on sale for like $10. And how do I know this? Because one Black Friday I bought like 30 of them. I went nuts. But anyway, and I'm still working my way through them. You can learn how to write hit songs, guitar solos. So anything you want to learn, you can probably find on YouTube or Udemy or Twitter or one of those other places. But here's the reason this is such a big deal. You can write off a portion of your cell phone. You can pay and write off family members. You can write off a portion of your house. I'll go through the entire list later this week. But for now, what's important that you understand is having a side small business is the number one thing that you can do to save on taxes, because it allows you to write off things you wouldn't normally be able to. For instance, my brother-in-law is a sign language interpreter, and he's college level good. Him and his wife both, that's how they make their living. My brother-in-law also has an interior decorating business. If you're in the LA, Orange County area, he's really good at it. But anyway, if you need a sign language interpreter, you got my brother-in-law as well. What's hilarious is for a while we used to see him in Vegas. He was Matt the Hammer. You guys might know who Matt the Hammer is. He was Matt's interpreter. It's a deaf I think he was a UFC fighter. They made a documentary on him. My brother-in-law wasn't in the documentary, but he's done some famous, I think he interpreted for Bernie Sanders once or something. Anyway, he's very good at it. We just went up to Cambria area, kind of like a family thing. While he was up there, they went to Cuesta College. They went to Hearst Castle to check out some interior design stuff and get some ideas there. And then they went to Cambria, Cuesta College, which is over in, it's not quite in San Luis Obispo, it's like right outside. And they looked to see if they needed any interpreting jobs. And so that trip, which was quasi-vacation, became an entire write-off for them because they really were up there for business. That's the sort of power. That's just one thing that you can do having a small business. So your 3 things again: HSA accounts are awesome. Why? Because unlike a 401k, which is fully taxed at your top tax rate when it comes out, HSAs aren't. So if you're going to use them and have medical stuff and you can get one of those, get you one of those. Secondly, if you have any bad stocks, mutual funds that are losing money, get rid of those. You can write off up to $3,000. But most importantly of all, if you can come up with an idea for a business, then that's the number one way, the number one tax shelter in America. And why is the government so gracious about that? Here's why. Because every Facebook, Apple, Microsoft started in somebody's garage or somebody's dorm or somebody's something or another. And then down the road, those companies went on to make millions and millions and millions, and in some cases billions of dollars, and turn around and generate jobs, pay tons of taxes, their owners pay tons of taxes, so the government has an incentive in letting you write off some of your own expenses to start out with, and then turn around, and if you're successful, they share in the profits, roughly to the tune of 30 to 40%. So they dumb. So that's your tips for today. By the way, if you haven't attended my college class on how to pay for college without going broke, be sure to check it out, ronscollegeclass.com. That's ronscollegeclass.com. It's on demand. You enter your name and email, and we'll send all the link right over to you. I can't just put it out there. You need to register first. But it's a great class. We're going to be doing another one real soon on getting in, particularly with the college scandal. So, and we'll be doing one in a coming week on alternatives to 401ks and IRAs. So you're not getting slammed with taxes and retirement we're not going to let them get you. All right, so it's Ron and Star signing off for today. All right, we'll be back tomorrow with some more tips. Take care. Oh, by the way, if you enjoyed this video as much as I enjoyed doing it, please be sure to share the love. Tell your friends, hit the like button, share this. We'll talk to you soon. Bye-bye.